This is a post-view and a preview of trading and investing for Tesla for the week ending in the 21st of March 2021. This is Greg for Teslafaninsight. Thanks again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. I'd have to say, also want to thank our Patreon supporters as well as our subscribers. If you enjoy this show, please take time to like and subscribe. So the focus of our talk is the fact that we haven't been doing sort of weekly trading wrap-ups because in general, there wasn't a huge amount to announce to a larger group. And we actually have a daily show on our Patreon that allows folks that are investing in trading regularly to actually sort of make an effort. So this show first is designed to go through kind of what happened this past week, and then let's look at what we're heading into in the coming week for both trading and investing in Tesla during that period. So it's been very difficult, as you can see. Probably the peak for the week is just over $700 a share. The nadir for the week is about $620 a share. And I think it was extremely challenging because after the Fed's announcements that they were going to continue low interest rate environment, we then had a nice pop for everything, including Tesla. And then the next day, the stock promptly went from 700, first all the way back to 650. And then with the news of what's going on in China, the fear of that resulted in stock price falling into the 620s. So I think this really highlights the challenges of investing, trading with Tesla. I really think that there's a narrative right now related to inflation that has kind of control of the market. And we saw it in the dramatic move of the stock in the past week. And I believe that where we are is we should expect sort of similar to the same. Now, you could argue that, hey, this is just a problem for Tesla right now, but if you go through all of the high growth stocks that have benefited in the environment of COVID, we're talking about PayPal, even Mara to some extent, but Square, Roku, there are a large number of companies that offered excellent earnings numbers, excellent growth prospects in this environment. And all of those stocks have gotten hit by at least 20%, if not more, and Tesla is one of them. So one has to ask the question, kind of what's going on here, why, and what can we expect going forward? So the answer is that, as you can see, we're primarily focused on what's happening right now when it comes to impact of inflation on everything. The next question is, once we answer the question about the inflationary impact, what are the scenarios that kind of fit the data we're getting? So the biggest thing that I would say is lurking here is the fact that when the job of a money managers or investors is to target firms that are doing well and invest in them. And it's considered a great investment if you're buying the shares of a stock at a price that's below their growth rate, which is definitely kind of what we're seeing here. Another aspect to this is the fact that is something I'll call fear. So if you look at the last sort of major crash I can think of was the dot-com bust in 2000. One of the things that ended up happening is people did this routine where they were like, wait a second, prices could fall, but what if the falling is huge? So there's kind of this discussion of the fact that, well, wait a second, I know it's only a 2% bond yield that you get or 2 or 3% as interest rates have risen. But if you have a guaranteed 2 or 3% from the government versus potentially what we've already lost is 20% on the stock market and on Tesla, with the prospect of losing another 20, 30% as the inflationary pressures really come on after the stimulus money. So we're now in an interesting position, which is 2 or 3% doesn't sound like a lot. But if you aren't losing a ton of money and you're neutral, be it in cash and getting a money market rate for your money, that's a lot of makeup for losses that you don't have to do on your portfolio. So I really feel like this is starting to play out in an uncertain environment. A lot of people will go to cash or perhaps Bitcoin, but also gold or, just sitting cash in their money markets until there's a consistency to what we're seeing. I guess I'd have to say I'm a bit surprised because solid operations that are resulting in solid growth and solid earnings only 6 or 8 months ago were where people wanted to be, and now that's changed. There's another variable that's sort of lurking that I'm seeing that I think is affecting things as well, which is, during COVID, at the peak of it, there's a concentrated group of mostly tech stocks. Microsoft comes to mind, Apple, all these different companies that are doing well, where people concentrated their money, so they kind of bid the prices up for those companies fairly high. On the other hand, let's look at, for example, companies that run cruise lines or other elements of the travel business. They got smashed. So there's another number that's out there, which is, can you earn more money from the growth of existing companies or existing, let's say, high growth companies, let's say pick Microsoft in this case. Are you going to make more with Microsoft at a very high number that's increasing? Or do you make more buying equities? For example, I'm thinking Royal Caribbean or Carnival Lines. The cruise business has been decimated. So their potential upside seems to be way higher than the increased rise of the value of already high stock prices. So Tesla did well last year. Obviously, it's down a bit this year, and it continues to perform. But the other question mark is, you're getting, all these other companies, be it the hotels, the airlines, et cetera, at a steeply discounted price, and their potential for a comeback. You have to weigh their potential for comeback against the continued high flying of those tech stocks. And the answer is that, there are a lot of tech stocks that don't actually pay dividends. Many of them do. Tesla is not writing a dividend check. But when you're dealing with some of these other old line companies, an airline, for example, they have growth showing as they get back to business, and they have regular dividends that they pay out. So it seems that what's kind of happening right now is a competition has emerged between go to cash so we don't lose everything, pick up depressed stocks that recover with COVID, and that seems to be getting a decent following. And then, where's that cash coming from, or where would that cash have been going to? And the answer is high growth tech stocks like Tesla in the process. So I really think that, there's a discussion of something called sector rotation. So people are kind of rolling out and saying, there's nothing wrong with the companies. They're doing fine. They're growing. Call it Roku, call it Tesla, et cetera. The problem is that there are just safer, better options, and cash or bonds seem to be one of those currently. So the question is, let's start to look at, well, where are we next week? So latter part of next week, the beginning of the following week, we're actually headed into Tesla announcing number of vehicles sold. And therefore you can imply what their revenue would be from that. And that's kind of what we're heading into in the coming week. And during this period, we often get either upgrades or downgrades from analysts because, once the numbers come out, I really think it shows the quality of their research departments in the process. So I'd have to say that, Kathy Woods just came out with a $3,000 price target for Tesla. And I think this is a beginning of what we're going to see of large numbers of people saying, hey, this is what we're anticipating is going to happen with the stock. Now, the question is, I think that most of the analysts are in that $700 to $800 range for Tesla, very few going over, let's say, $850 as a target. What you tend to find is the larger the group is at those higher numbers, the better the chance that the stock will start moving in anticipation of that. So what we're expecting, frankly, this week is a bump in Tesla stock price, with the impactor being sort of good numbers for the quarter. The biggest thing that's lurking in my mind here is the fact that in China, we have a situation where they actually sold out a Model Y that are made in China based on the low price that was offered for this quarter. So I think that it sort of suggests that, hey, their numbers are going to be better because you have to add the Model 3s they were selling at a good clip with the Model Ys, and that shows one of the key growth points. The other thing we were noticing is if you look at the trucks and you go to the research, the sales facilities around the country, the move to the Model Y is dramatic. I experienced this, and we're getting feedback from other viewers that Model Y is really doing extremely well everywhere, and it's really sucking people away from the Model Y, X, and S, and even the Model 3s. And so, there seems to be solid sales, solid everything. It's just that the stock isn't getting support as we have all these other issues lurking. The one other thing that we've been covering regularly is the fact that, look at inputs. Oil represents 2% of the costs of every company, every individual. You got to buy gas for your car. You have to pay for example, paint for Tesla, the company that provides the paint. Those guys are paying 2% more. So tires. Let's name all these inputs. So even if you have nice growth for certain entities like Tesla, you do have the challenge lurking of, wait a second, all your suppliers now have an increased cost related to oil in particular, because I know you can see it when you drive by your gas station. But I was really thinking about, look at an increase in commodity prices across all of those elements, and you now start to see why the market is kind of skittish, because yeah, you might be doing well, particularly if you're delivering a product or service and it's impacted by oil price and other increases in commodity prices. This is one reason why you may have to discount the growth rates of revenue and profit that are out there as the impact of these increasing costs are felt, and this is the inflationary process. I would say the one screwy thing that's happening here also that's sort of challenging to observe is the fact that, yes, the Fed is finding ways, Fed and the Treasury are finding ways with stimulus as well as keeping interest rates low to address what's going on. But literally, the bond market has the power to say, hey, we're basing our interest rates on what the inflation rate is. And even if you guys can try to slow it down with the levers that you have, you're still stuck with that inflation created by the very things that you're using to juice the economy. So I believe that there's a lot of conflicting data points out there, like consumers have more money to spend, they can spend it with retailers or in other ways, travel, et cetera, that they weren't able previously in COVID. But at the same time, one example would be we're flying more, which is good. Hotels and all the other beneficiaries are going to benefit from that. But at the same time, they're using a lot more jet fuel, which an increased use of anything means prices rise. So the bottom line here is we have a lot of different variables all in flow at the same time. And this is resulting in a huge amount of volatility of unknown what's going to happen. And frankly, I'm expecting this to continue. What's going to happen with Tesla? Great question. I believe that based on how badly things have gone for Roku, Priceline, some of the other companies that have done huge numbers and are not really impacted by COVID or even inflationary pricing, I'm surprised to see them down, but I think the logic shared sort of articulates the nervousness in the marketplace. And then the final thing I'm sort of stunned by is to watch the speed of movement. Now that we have both consumers and large funds, using all the techniques related to robots or bots to control their downside. We're just seeing dramatic movements that might even be considered the equivalent of a crash in the short term happen because people are wanting to make sure they get out as quickly as possible, limiting their downside. So I would say if you're choosing not to exit currently, I think it's a good idea to consider putting some hedging in the form of puts against the S&P or possibly against the stocks that you own to better manage the downside risk, because it feels like right now another 10 to 20% down for the market / Tesla is definitely a possibility, even though the numbers are great. The big question is, when do people return to their senses and start buying again? And the answer is nobody knows. But I would say that one of the lurking problems out there is, well, what happens if COVID reignites and a lot of places that were reopening are now forced to close again? So there are all these unknown question marks, so you can't maintain a consistent up or down linear sense of what's going to occur. And I think all of this uncertainty really adds to the challenges of figuring out what's going to happen. What I personally think is going to happen, I think Tesla's going to show and have great numbers. They're going to be able to forecast that they're doing well and have orders that support that. But if PayPal or some of the other entities that are similarly high quality growth stocks are getting their stocks decimated after delivering great numbers and forecasts, I don't see how Tesla escapes a similar treatment by the market. And so therefore, it's my sense that we're going to see good numbers, very good numbers from Tesla. But unlike 6 months, a year ago, I think it doesn't do much. It just perhaps keeps you at or slightly below where you're at, rather than having it push the stock nicely. So I'm hopeful that I'm wrong, that all of a sudden everything will be fine in a few days. But I really think this inflation back into things and other options for managers to buy instead of just a core group of successful COVID-based companies is really sort of shaping what's going to happen in the near and long term. So just a reminder, please take time to like and subscribe if you enjoyed. Join us on Patreon if you'd like. We do have a few shares of SpaceX as well. If you're interested there, please send us a private message on Teslafaninsight on Facebook if there's interest there. I wanted to now move on to our health tips. We've actually got them written down below the usual top 5 that we tend to do. And therefore, I wanted to, as suggested by one of our viewers, introduce some other sort of tips of things that you might want to consider doing. Number 1, I wanted to review with you a couple of items I've been working on. One of them is I went and visited an internal medicine specialist at Stanford many years ago. It's been about 15 years. We were having a discussion about workouts and the impact on the body. And what he pointed out was something he called, I guess we could call it the 15-minute rule. So what he suggested is first thing in the morning when you get up, try going for a 15-minute walk very quickly. You could even do laps around your house or your living room and try to, just make it a brisk walk. The logic behind this is that there are a lot of people working out 2 or 3 times a week. What happens though is if you do that brisk walk on a daily basis within your house, and then at a later time, be it soon thereafter or later in the day, you might choose to do a workout. What actually is going on is that brisk 15-minute walk allows you to consume the calories that you've eaten or will eat for that day. Now, when you do your further exercise, you'll find that that other exercise starts to cut into fat storage that you might have. And now, instead of saying to yourself, I keep working out and I don't seem to be making progress, this sort of highlights how your body is reacting to workouts. And so I just want to note to you that those calories from today need to be burned off. That way your workout can impact fat storage, etc. So that's our health tip for today. Also, I don't like reminding you of this, but I did have a really good friend of mine. Her name is Susan. We went to high school together. And I had a really good conversation with her, and she pointed out that she struggled with her weight for a long time. Her dad was a doctor, and she went to a number of specialists to try to get help. And one of her specialists that she met with gave her an eating assignment, which was, for the next month, I want you to look at the packages and only eat things you can pronounce or know what they are in your food. And after she did that, completely had a breakthrough on her weight issues. And so I kind of wanted to bring this up to you because, if you're having some challenges with losing weight, et cetera, like, for example, the high fructose corn syrup that you might get in that soda, all that stuff that you can't pronounce, leave it out for a couple of 3 weeks or a month and see how that impacts you. How do you feel afterwards? Are you noticing better weight control, et cetera? Because there are a lot of really cool chemicals that have been developed over the years that our bodies are not comfortable with, and therefore you have these reactions, and one of them is storage of a lot of weight. So I just wanted to encourage you to consider that idea because I think it's not hugely time-consuming energy-wise, et cetera, but it might be worth consideration. At any rate, this is Greg for Teslafaninsight. Tschüss, German. Au revoir, French. Lehithro, Hebrew, Hoda, Hafez, Farsi, Strasviche, Russian, Ni Hao Ma, Chinese, Konbanwa, Japanese. In G'day, our friends in Australia. And in Jamaica, we say, Nuff respect, walk good. Namaste, Hindi. Have a great day, and bye for now.